Hi guys, this is Chuck Wilson from Century 21 Deal. I'm coming to you today with another video on mortgages and real estate, and this time it's how they're related. Joining me today is Adam Wells from New American Funding, and he's going to explain what the Fed is trying to do whenever they increase interest, the Fed rate.
You bet. So there's more data this week, more information coming out. We've got another Fed meeting next week. So everybody wants to know how interest rates are impacted by the Fed and what that has to do with the mortgage rate market. So the Feds don't necessarily control what's happening in the mortgage market. They do control monetary supply, which has an impact in mortgages, but they don't directly impact us, say, one for one.
Okay. So now the Fed is out there raising the prime rate, and so how does that affect mortgages that we see when somebody's buying a house?
You bet. So I would say that the mortgage-backed security market is just that. It's a financial market, and so when there's fear about inflation, there is going to be higher prices in mortgages. So basically, what happens is that investors are looking for a safe place to put their money. So when there's volatility in the stock market, we'll see more people moving into more safe and secure options like bonds and mortgage-backed securities. The problem when we have inflation is that doesn't seem like such a good bet anymore. So we have to raise our rates in order to attract those investors, and that's what we see right now. We're in inflationary times, and we're in a higher than normal interest rate environment.
Okay. All right. Well, I think that pretty much explains it. We need investors, right?
That's right. Yeah. So most mortgage companies we sell our products on the secondary market. So we've got a huge line of credit. We originate loans. And then we need to sell those loans on the secondary market in order to continue to originate loans.
Okay.
So we're always trying to do a balancing act between what the consumers are willing to bear in the interest rate and what the investors are willing to buy once the loans are packaged and ready to go on the secondary market. So what we've seen is that in between these Fed meetings, we've seen higher interest rates. But typically what we've seen is actually right after those meetings, when there's decisive action taken, the market responds positively in lower interest rates overall.
Okay. Well, it sounds like to me the Feds are meeting next week, so next week is really a time to
It'd be a good time to lock your loan.
Absolutely. And as Adam said, the investors, that's where we get our money from, for where you get your money from. Exactly. To make loans. Mm-hmm. And so it's very important how Adam did a very good job of explaining how the two are related. I hope that clears it up, guys. So if you have any questions, again, call, write, email me. And I do appreciate Adam coming on.
Absolutely.
And explaining this. And we'll see you next week.